Okay, good morning and happy Tuesday, and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what I want to discuss is really where the markets are headed next, now that we have seen more of a stabilization here from the markets. But before I get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, we're going to start off like as usual on our market updates. This is really where we're going to find more evidence of the stabilization that we're talking about, but also what we're going to see is some of the cracks that we're starting to see in this market. And that's going to help us define our views as far as where are we headed next now that we have seen the stabilization. For that, we're going to look at some of the sectors as we start to see a little bit more sector rotation here. Some of the weaker sectors starting to come up in that, and further weakness we're seeing in some of the other sectors. We also want to point to fixed income and commodity markets that provide some of the more bullish views here actually in this particular market, and what balanced by some of the more issues that we kind of start to see in the markets when we look at volatility and we'll look at some other indices. And then we'll take a look at some of the ideas that also shapes our view as far as where markets are headed next. And lastly, if you have a few minutes, we'll try to answer some questions here from the audience. Now, before I get started, the primary question that I want to help investors answer is really where, now that the markets are in a much more stable state, which we'll show you here with some charts to show you why we feel that way. But the question is, what's next? And this is really where I think the views here are fairly mixed. And I'm actually curious as to gauge the audience here. How many of you feel that markets have now stabilized and will now resume its bullish trend? Please type 1. And how many of you feel that markets are stabilized but it's going to continue moving down? Please type 2 into the chat window. I'm curious as to see the audience. So the sentiment here seems predominantly the same here as when we asked this question here on Friday, which is the views are fairly mixed here. There isn't a strong consensus one way or another that markets are stable and they're going to continue moving higher, or they're now going to continue moving lower. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. What I want to do today is share with you my charts, my technical research, and the different indicators that I'm looking at that helps shapes my view as far as where markets are headed next. And the reality is that it is a pretty mixed bag of indicators at the moment that we're currently taking a look at. And we certainly see more risk skewed to the downside than, now that the markets have stabilized a little bit here over the past couple of weeks. So my primary thesis since the initial sell-off was that this sell-off was going to be fairly contained, was that this was driven mostly by delta hedging here from market makers, that this wasn't some kind of larger structural sell-off here in the markets. And that thesis for the most part has held up with the NASDAQ 100 or the Qs holding that 270 level. We've had multiple days of pretty, I would say, sideways price action here. Nothing particularly strong, nothing particularly weak. The one thing I will point out here is that price action shifted a little bit here over the past couple of trading sessions, where predominantly what we were seeing was price action, markets opening higher, and then throughout the day trading its way low, or sometimes closing at its lows or at new fresh lows. Over the past couple of trading sessions, we have started to see this shift a little bit, where we're opening up higher and it trades roughly either neutral or a little bit higher. Today, we're opening up higher again. So the question is whether price action is going to continue moving higher or it's going to start weakening again intraday. That's some of the price action, intraday price action, that helps us define where we're headed next. But we're trading in this fairly narrow trading range between this 285, 270 level or so. A fairly sizable range, 15 points here on the Qs. And the question is whether we're going to continue moving higher or continue moving lower. Now, when we look at the momentum of the market, we look at some of the indicators, the underlying indicators, I'm putting less of a probability of this breakout and a substantial move higher here. And I'm starting to put a slightly higher probability to this move here to the downside. However, I will say that until the market cracks below this 270 level, I wouldn't put any weight behind putting on any short opportunities here in the markets. But again, I want to point out some of the short opportunities that we do see here in this market. But starting to put less probability on this move higher here and slightly more probability on this move lower. And at least for now, what I'm really playing for is really just a sideways consolidation market here in between, where when we have high volatility yet stabilization, that is an opportunity to generate yield, selling cover call, selling cash secured puts. These are the types of opportunities, and we're just going to have to wait to see where markets head. You know, are they going to break out higher, or if they're going to break out down to the downside? So let's take a look at the other markets to provide a little bit more evidence. When we look at the S&P 500, this is really, we're just wavering above and below this 339 level, which is the high in February 2020. We closed below that level. We're about to open up above that level. And the question is whether or not markets can continue to move higher. Now, the S&P 500 looks like, based on today's open, going to open up above the 20-day moving average. This would be fairly significant in terms of resuming a bullish momentum here in the markets. And perhaps what we're going to see is a resumption of a bullish trend here on the S&P 500, while the NASDAQ 100 kind of in this time zone actually starts to reduce some of its relative strength. So we're going to start to see rotation out of tech into some of the other sectors, and that's going to be my primary thesis here for the current market environment that we're in, and what we're going to see here over the next few trading sessions and perhaps the next couple of weeks. If we look at the IWM-Small caps provided quite a bit of protection here to the downside. It's gaining a little bit of relative strength here on the upside as markets stabilize and start to bounce higher. But that gain in terms of relative strength is simply not enough to reverse the multi-year slide that we have seen here in relative strength from small caps. The only strength that we saw from small caps was during the recovery. Ever since June 5th, small caps relative strength has continued to decline. So even though the past couple of weeks provided a little bit of gain, not quite enough, in my opinion, to turn things around. So market rotation continuing to just less trade sideways, and potentially will continue to also fall back behind if markets can continue to rally here. We're seeing that across small caps as well as equal weight indices. If we look at the RSP, the S&P 500 equal weight index, making no progress here over the past couple of months, or rather past 3 months or so. Playing a little bit of defense on the way down, so playing a little bit of catch up, but not quite enough to really make any gains here from a relative strength perspective, gaining very little. So the market health here still remains not particularly strong here, especially over the past couple of months. It's weakened and it hasn't really gathered much strength here. So this also puts a more of a cap here, in my opinion, to the upside here of this particular market. If anything, we're just going to see some sector rotation out of technology, out of perhaps discretionary, into some of the lower sectors, which we'll take a look at here. So one of the sectors that we're looking at some rotation into is actually materials. If we look at materials here, it's one of the few sectors that has managed to break back above its February highs and continue that move higher here. The weekly chart remaining fairly strong. Momentum indicators confirming those moves higher. Relative strength also fairly strong here on the weekly chart. The daily chart not particularly strong, but looking like it can potentially break out here above the $66 level here. The all-time highs here for XLB is around 66, so I'm looking for a potential breakout here above 66 and continuing its move higher. Materials is really one of the few sectors at this point that's gaining a fair amount of relative strength here, because it did provide quite a bit of defense on the way down and is now providing a lot of the gains here to the upside here in the broader market. So this is part of where we may see that the S&P 500 is going to perhaps outperform the NASDAQ 100 over the next few days, as it has over the past couple of weeks. Industrials is also another sector, not quite as strong as materials because it hasn't gotten above its February highs, but really one of the sectors that we've been pointing out for quite some time, because it has broken above that $80 level. You've got that breakout, it's trading sideways here and has the potential for a continuation higher into that 85 area here for industrials. And we'll take a look at some commodities that also support this view of a potential breakout here for industrials. On the flip side, we see utilities actually continuing to decline from a relative perspective. So on an absolute basis, it's just moving sideways. But as the markets continue to march higher and you have a sector like this that just trades sideways, this is continuing to decline on relative strength. Utilities, one of the biggest movers to the downside from a relative strength perspective, alongside energy. Energy is still the worst performing sector and is still likely going to be one of the sectors that is going to see further declines here, but utilities, certainly one of the markets that are likely going to trade sideways here, as the extensive or the high amount of yield that we're getting from utilities not attractive enough here for investors. So this is also another sign that perhaps markets are going to be stable and not going to sell off here, at least not in the short run, because if we look at fixed income markets, this also confirms this view. When we look at high yield has not budged at all over the past few weeks. If markets were really stressed and things were not looking okay and things were starting to move a little lower here, we would see high yield react to this typically first, as we saw high yield react very strongly here to the coronavirus sell-off. We have seen no reactions here from the high yield market. This is really the segment of the market that usually tends to react fastest from the fixed income side, versus when we look at treasuries, we have seen a decline here in treasuries. So what this points us to is more of a risk on environment, meaning investors are seeking higher yield, meaning riskier assets, and selling off less risky assets such as treasuries. This again confirms our view that markets are fairly stable. This doesn't necessarily mean that markets can continue to move higher, but it also does confirm our views that at the moment, markets are not fearful, markets are not concerned of a major correction here in the markets. So this kind of forms our more neutral view here in the markets, that until markets break lower, below those 270 levels on the Qs, that we start to see some reaction from the fixed income markets. This does not justify, in my opinion, going short, but it also means that we don't see a lot of upside as we see more of this sector rotation, especially out of technology into materials and industrials. The two kind of offset each other, especially when you have energy and utilities continuing to weaken. This type of sector rotation is relatively healthy for the stabilization of the markets, but not necessarily a big driver of potential upside here for the broader markets here. So mixed picture across the board, but volatility indices supporting, again, the stabilization theme. We're starting to see the VXN, the NASDAQ 100 volatility index, continue to fall below. It actually fell below the 20-day moving average yesterday, and is looking like it's about to open up even lower here, closer to the 200-day moving average. But despite the stability, volatility is still remaining very strong here in the 33 zone, which is double what we saw here back in February. So when you have double the volatility, more than double the volatility that you saw back here in February, what that means is that you still have a very strong opportunity to generate yield. So especially when you have these neutral markets, selling call credit spreads on stocks that you think have limited upside, selling put credit spreads on stocks that you think are fairly stable and is likely going to continue moving or grind its way higher, those are the types of strategies that you want to use, including cover call strategies on stocks that you own. You're going to capture a fair amount of yield on selling covered calls right now. So those are the types of opportunities that you want to seek here in this current market environment. Now, when we look at the VIX 3M versus VIX, this again supports our stabilization view, but there are also some concerns here, is because we're fastly approaching back into that complacency zone. This complacency zone is a zone where we would, generally speaking, start to pare back our long positions and be concerned that there could be some violent pullbacks here in the markets. So we certainly got that violent pullback that corrected away from that complacency area that stabilized the markets, but we're quickly approaching that level again. And this is some of the downside risks that I see if this metric gets back above that 1.25 level, then we can start to, again, pare back some of our long positions again and start having more of a balanced view in terms of having long and short positions here in the market. But until we get up there, my views is still more stabilization. If we take in all the different factors at play, I would still put a bit of a more bullish bias here on the markets rather than a bearish bias. But again, there is growing evidence that there are cracks showing here underneath the surface. A metric that we've also, paid attention to even before the sell-off is the number of stocks that are trading above its 20-day moving average, which is still in a bit of a worrying trend over the past month. It has improved a little bit, but the fact that you have the major indices within 5 to 10% of its all-time highs, yet only 40% of stocks are trading above its 20-day moving average. What this speaks to is the breadth and the narrowness of the breadth of the market, meaning you have effectively what are just a few major mega cap names dragging the markets higher, while the rest of the market, most of the stocks in the market, are lagging behind. This is not a good picture for healthy markets that are going to continue resuming another 20, 30% higher. Can this correct itself? It certainly can, especially with sector rotation, if we see more sector rotation out of technology into some of the other sectors. But at the moment, this is a worrying trend. It could reverse, but this is one that we're paying attention to, and this is one that you should pay attention to here as well. On this rotation theme, when we look at industrials, precious metals has really dominated the headlines here for the past couple of weeks, past couple of months. But over the past couple of weeks, we continue to bring up copper, industrial metals, really becoming the leading theme here, while gold and silver is trading sideways, so actually losing ground here to the industrial metals. Copper continuing to gain ground, trading near 2-year highs here. We brought up this $3 level here a few weeks ago. It's, which has acted as a major support or resistance level. It broke back above that $3 level. So we now see further gains here to the upside here for copper. This supports our view that we have this rotation here into industrials, because copper is a real-time indicator of industrial demand. This gives us more in terms of evidence for this rotation into industrials. Now, when we look across the board, some of the ideas that we see, so like I said, I see fairly limited upside here, but if we look for any upside, we want to look for it in the sectors that we are starting to see some rotation into. So transports, industrials, these are the types of sectors that we're taking a look at. We're seeing quite a bit of strength here from the industrials and the transport names. So if we look at CSX has started to gather a bit of strength here over the past couple of days, trading just below this $80 triple top here, and we're looking for a potential breakout here. This is the type of name in the current market environment that I'm looking at, where I would be a little bit more conservative. Instead of playing for the breakout and buying call options now, I would look for a breakout here and wait for a retest and use that as an opportunity to potentially go long. And the reason for that is because if I enter the market here, all it takes is a small decline of just maybe a couple of bucks for this to stop me out and for me to get out of the trade, while giving me a fair amount of upside opportunity. So the risk to reward ratio on a trade like that looks far more attractive than if I enter the trade right now, because if this failed, I have a lot more upside with a fairly small amount of upside, in my opinion here. So I would look for a breakout here, wait for the retest before you look for long opportunities here in this market. So I think to take new long positions here in this market, you need to be really selective with stocks that are in particular sectors that are rotating, that we're seeing rotation into, and wait for the ideal setup from a risk to reward perspective. And then further, try to limit your losses to the downside by using strategies like call spreads, put vertical spreads, any types of limited risk strategies, so that you're able to protect yourself to the downside. Because again, growing evidence that there is downside risk growing here in this particular market. If we look at travel stocks, this is really where we are starting to see this rotation from a theme perspective in terms of lockdown stocks versus reopening stocks. And we've seen a significant decline in some of the lockdown stocks. Those are some of the names that I want to point us to here today. But on the same token, we're seeing this rotation into some of the reopening stocks. We're seeing this across the board from travel. If you look at airlines, if you look at hotels, if you look at Expedia, those are some of the names that we're starting to see some significant gains to the upside here. So Hilton, I was looking at the Hilton chart here, and this is one that looks fairly constructive, and this is one that represents some of that price action that I was talking about, where you get that breakout, you wait for a retest, multiple retests actually in this particular case, and now we see that we could potentially get that breakout here. So far lower risk bullish trade here, in my opinion, in a name like Hilton, than waiting for a breakout. We see this in Expedia. any type of these names where we're seeing this type of rotation into some of these, into travel stocks, where you have a chart set up that makes sense from a risk reward perspective, and you're able to leverage options to limit your risk here to the downside. Those are the types of plays that I would be looking at from travel stocks, because travel stocks tried to rally here initially in early June, quickly failed as people realized the second wave of coronavirus was coming into play. We're starting to see the number of cases continue to decline, and I think this is partially putting a little bit more confidence into some of these names, but I would focus more on the leisure type names rather than the corporate travel names. Stay away from the ones that are focused more on corporate travel, as they have not seen any uptick in corporate travel compared to leisure travel. On the flip side, when we look at the technology names, there are also cracks starting to show here in some of the price action on the high-flying FANG names. Specifically, if we look at Facebook, after having a significant decline, the price action has been particularly weak because we are still trading near those support levels here. Unlike the Qs that have managed to break back above some of those levels, the Qs trading at 275, opening up around 277, 278. That's a fair amount off of that 270 support level. Facebook is actually pushing those support levels. So price action here on some of these names in the technology space starting to lag behind. So as the Qs starts to continue to move its way higher on shares like Apple and Tesla, you have Facebook and some of the other names starting to fall behind. So this paints a sort more of a neutral view here on technology, and this paints our view as to why we're going to see, in my opinion, a rotation out of technology, as some of these high-flying names like Facebook is starting to see some some weakness, and can potentially break below some support levels and start to bring and drag down the Qs or the NASDAQ 100 index. So this is some of the risks that I do see here with the technology names, and you see the same thing here in Google. Google actually looking even weaker. Google wasn't particularly strong on the move higher because it barely really got much higher from its highs and quickly came back down. And price action here over the past few days is also weak because as technology starts to grind its way higher, Google is actually continuing to grind its way lower, so diverging away from that technology space. So these are some of the risks the downside risks that I see here in the NASDAQ 100 index. This was not what we saw here before, and this is something that is concerning to me. Another stock that is part of the lockdown stock, Electronic Arts, but we're seeing this across the board with a lot of the lockdown stocks, with Etsy, with eBay, some of the second tier names in this particular space that drove a lot of the gains here in the markets during the June to August rally here, starting to see some declines here. So this stock actually managed to break below some major support levels and is now looking even weaker and might continue moving lower here. And again, we're seeing this across the board. It's not just Electronic Arts. We see this on eBay. We see this across on a lot of the names that have been in that lockdown category. And then we're starting to see the reopening trends start to pick up. So we're starting to see, if we look at high frequency data like open table dining seats, if we look at mobility trends, we are still continuing to see upticks on those particular levels. So those are pointing to more reopening trends versus lockdown trends. So we're starting to see this shift in the market. So the shift, again, is not particularly bullish or bearish. It just is a rotation that we're currently seeing. And I think that speaks to more of that neutral view. But if we take all the factors that we talked about here today, I still think that if you add this all up, there's still more of a bullish tone here to this market rather than bearish tone. So my view is that we're going to grind our way higher until we see some other catalyst that can potentially break the camel's back. But until we break below those 270 levels here on NASDAQ, until the S&P 500 starts to get back below those February highs, I am not in the camp of go out there and buy puts or short some of these names. You could sell some call credit spreads here on names like Facebook, Google, Alphabet, Electronic Arts, eBay, but I wouldn't go out there and buy puts just yet because volatility is still really expensive on that. We don't have any signals of that acceleration here to the downside just yet. There certainly are warning signs. There certainly are risks that are rising here to the downside, but we don't have a catalyst just yet. So That's my view here for the morning of September 15th. I know it's been a volatile couple of weeks, and a lot of investors are asking what's next. That's my view. I hope that this was helpful in giving you a better understanding as to how to position yourself here for the markets going forward. So with that, it looks like I do have a couple of minutes to try to answer a few questions here. If anyone has some questions, you can type them into the Q&A window, or rather the chat window. FDX reports earning after the bell today. Straddle pricing a 10% move, so could reach double top 264. How would you play this? You know, my views here on FedEx is I think FedEx is going to have a fairly strong quarter here, but I do feel that this is the type of stock that's got a little too far too fast here. You know, the growth here in FedEx is not, I do like FedEx more than UPS. And I do think a lot of the exuberance here in the markets that drove some of these big moves to the upside has kind of largely leveled off a little. If you look at Peloton, if you look at some of these names, you know, basically it was buy the rumor, sell the news type plays. That's my view here for FedEx. You know, but I don't have a position here in FedEx, so that's the most that I can really say. Has the GM trade gone sour with the SEC launching an investigation fraud on Nikola? So one of the things I mentioned here on last week was that whether Nikola is a success or not, I think the impact here on General Motors is going to be relatively minimal, right? You have the stock still trading well above that $30 level. You know, long term, I still like GM, and I think what you have here is effectively you know, an upside call on Nikola through GM, a much safer way to play Nikola through GM rather than buying calls on Nikola. So nothing in this particular changes my views here on GM. It's tough understanding your chart time periods without the date reference. So all of our charts will always be weekly chart on the left, daily chart on the right, and you can see on all of our charts, whoops. We always have the date time preference here on the bottom so that you can see the duration of each chart, but it's always a weekly chart on the left-hand side and a daily chart here on the right-hand side. Tony, in the current market, what delta makes sense for cover calls, assuming 5 to 6 weeks out? So, you know, with the current market environment, you can get a little bit more aggressive. Normally, the optimal credit cover calls the 10 to 20 delta. I do think in this current market environment, you can get a little bit more yield, getting a little bit more aggressive, especially if you agree with me that there's limited upside, changing that to closer to that 30 delta for that cover call. NVIDIA, you know, I like NVIDIA out of the chips, even though the chips are starting to be a little weaker here. And I specifically love NVIDIA for that ARM deal that they're about to close, if they can close that deal. I think that's a big deal for Apple. I think that's a major milestone for Apple to bring all of their devices onto one chip. And if ARM is that chip that delivers that, I think this is a positive here for, I think NVIDIA plus ARM makes probably a far better, you know, makes Intel kind of really just lag behind. I think NVIDIA and ARM is the future versus Intel if they can get that deal done. What's your view on Teladoc? You know, Teladoc, still same view here. I think Teladoc is a strong company from a revenue and fundamentals perspective. You know, we're still waiting for we're still holding this 190 level here. So my view is that TDOC will hold this 190 level. Yes, we do have Tom Sosnoff still on for 415 here today. Precious metals, gold and silver, like I said, not moving at all. That's my view here, is that it's going to continue. You got to wait for a breakout one way or another. Which way is it going to break out? I really don't know, to be perfectly honest. If I had to venture a guess, I would say it's more likely a move to the downside as inflation expectations really start to kind of taper off. We haven't seen this explosion in inflation expectations we were hoping. So I think gold and silver more likely to break to the downside here on this consolidation range. What's your expectation on FOMC policy meeting? I think that it's going to be largely the same. I think we're going to have a little bit more language around when they might raise rates or what qualification they need to raise rates. But you know, I think right now no one expects rates to be elevated anytime in the next 2 to 3 years. So I think that language is largely going to be a non-starter for the markets in terms of direction. what goes into the strategy choice on the credit spread report? So all the credit spread reports are always going to be credit spreads. So it's always the same strategy. If you're referring to the technical side of things, it's always looking for either overbought stocks for call credit spreads or oversold stocks for put credit spreads. I have a QQQ long position. What strategies can I use to protect or hedge it other than expensive put? You know, the best way to hedge, a long stock portfolio is actually short futures. But again, you know, if you're really concerned about, you know, a decline, you know, best thing to do sometimes is just moving into cash. That's the best hedge you can always do. Okay, looks like market's about to open up here where we just opened up. Qs are about 1.3% higher. S&P is about 0.8% higher. S&P now above that 20-day moving average. Qs just slightly short of that 20-day moving average. Let's see how price action shapes up today, whether we get an open and then continues to move higher, or an open and starts to move lower. Again, that shapes my views here on the short run. Thank you so much. I hope you guys find this useful in helping you set up your day. Have a great trading day, and I'll see you guys this afternoon with Tom Sosnoff at 4:15 p.m. Have a great day.